What are financial underwriting guidelines? I'm talking about max funded indexed universal life in this application. It's critically important to understand how to get approved to structure an IUL policy to be used as a living benefit, tax-free accumulation of your money, tax-free accessibility, tax-free income, and then ultimately when you die, it usually blossoms, increases in value, and transfers income tax-free. That's the beauty behind max funded IUL. It allows you to accumulate, access, and transfer your money totally income tax-free because nothing else does that in the Internal Revenue Code. And so when you apply for an IUL, you've got to make sure you get approved medically, you're healthy enough, and also financially. Get ready, because you can't just take out as much insurance as you want, okay? You have to justify the amount of insurance by going through underwriting guidelines. So get ready. I think you're going to gain insights into how you do this when you're structuring an IUL policy, and you'll learn some things that maybe you didn't understand before. So I'm Doug Andrew, and I've been doing this now for 5 decades. What's this? Well, it's helping thousands of Americans prepare for long-term goals such as retirement, college savings for their kids or grandkids, working capital for their business, keeping your money liquid and safe if you're wanting to become your own banker, as a business owner, a real estate investor, maybe estate planning. There are so many uses. I call it blades of a financial Swiss Army knife. A properly structured max-funded IUL is the dream solution for many financial goals. So you need to understand right off the bat that when you understand that concept, what you're doing with a max-funded IUL is you're designing it to be used primarily for life, not for death. And this is the brainchild of E.F. Hutton, okay? Now, when you understand that, you're structuring an IUL, as you will learn on many videos on this channel, that you calculate the amount of money, your assets, that you want to reposition, be it money trapped in IRAs or 401ks, and you want to roll that out of there. Maybe it's rental properties that you're sick and tired of being the landlord, and so you want to sell those and you're wondering where to put the money. Maybe you're inheriting some money. Maybe you're getting a settlement. Maybe you're getting a lump sum option at retirement. Maybe you have money socked away for emergency funds. But whatever the goals are, you want to look at which assets that you want to increase the liquidity, the ability to access your money when you need it. You want to increase the safety, okay? You don't want to lose money when the market goes down. And you want to increase the rate of return and not lose money when the markets drop. And you want to make sure it's totally tax-free, not just tax-deferred. So this is what we call the laser test, okay? Liquid assets safely earning returns, okay? You want to increase liquidity, safety, rate of return, and the tax benefits on assets that are not passing those tests very well. And I actually have a numbering system in my book where you can score liquidity, safety, rate of return, and tax benefits on a scale of 1 to 10. The reason why I love a max-funded IUL that's structured correctly, because it scores in all of these 8 to 10 out of a possible 10. When you add it all up, it scores 35 out of 40. Most Americans have their money in investments like IRAs or 401ks or mutual funds or annuities or banks or credit unions, and the score is only 18 out of 40 or 20. It's only half of the score you could be getting, okay? So once you understand that, and I'll show you how you can claim a free copy of my book at the end of this episode, you then need to see if you qualify, okay? Because once you want to design an IUL policy to increase liquidity, safety, rate of return, and the tax benefits, you're trying to take the least amount of insurance you can get away with and put in the most premium or money the IRS allows, so it turns into a tax-free cash cow. Nonetheless, the insurance company is still going to be on the hook for a certain amount of risk, especially the very first day, very first year of the policy. So let me try to keep this simple. If you were a normal, 60-year-old and you were wanting to reposition $500,000 in the next 5 years into a max-funded IUL, the objective is so that your $500,000 will grow tax-free, then it will double to $1 million tax-free. And then that million doubles to 2 million tax-free. 2 million doubles to 4 million. 4 million doubles to 8 million tax-free. Yeah, we've had many, many clients do that. That's the objective. You want the best rate of return so that at the end of the day, you can have every million that you accumulated can generate $80, $90, $100,000 a year of tax-free income without depleting principal. That knocks the socks off of the financial services industry standard of they only want you to pull out 4%. On $1 million nest egg, they only want you to take out 40 grand a year. A property structured IUL, you can take out 80,000 or 100,000 a year without depleting principal. A max funded IUL, a laser fund, isn't a little bit better. It's double or triple the income at the end of the day, okay? So once you understand that, then you need to apply. And so what you're doing, let's go back to the 60-year-old. For $500,000, that 60-year-old could buy a whole bunch of life insurance for $500,000. That's not what your objective is. You want the least amount, and that's only $1 million. So you need to qualify for $1 million of life insurance. Well, we have many people that want to reposition $1 million or $5 million. Well, the amount of insurance is $10 million. So whatever the death benefit is, as dictated by the IRS guidelines, TEFRA and DEFRA, you have to qualify for that death benefit, meaning the minute the insurance company approves you, they're on the hook for the risk if you died, okay? So let's simplify this. If it's $1 million death benefit and they approve you and you put in the first 100 grand and you die, they're on the hook to pay $1 million, okay? 10 times more than what you paid. So they need to manage that risk. Now, when you're maximum funding an IUL, one of the beauties of it is if you put in $100,000 because you're paying the most the IRS allows, not the minimum premium, because you're using it for living benefits, but if you happen to die in an accident or something, or a heart attack that you couldn't detect, you put in $100,000, the insurance company's really only out $900,000 because $100,000 of the million is your own money. Now, if you maximum fund it as fast as you can, which is done in 5 payments, which technically could be done the first day of each year. So the first day of the 5th year is 4 years and 1 day into the policy. You've got your $500,000 in there, but if you died then, the net amount at risk is only the remaining $500,000 of the million, because half of that is your own money. Now you are self-insuring. You are owning the death benefit. Why would you do that? Because you're slowly converting all of your assets to be totally tax-free, which is very, very smart. Okay. Now, when that $500,000 doubles to $1 million, which happens usually in 7.5 years based on our average returns of 9.6%, now you have $1 million of cash value. Now the insurance company's not at risk for anything because your cash value has grown to equal the original death benefit. But the tax citations simply say, if you die after that, after your cash value grows to equal the death benefit, the insurance company will pay out 5% more. So if you had $1 million in there and you die, they'll pay out $1,050,000. But they're only charging you for $50,000 of insurance. The interest on your $1 million is so much more than the cost of $50,000 of insurance. This is how the cost of insurance gets cheaper as you get older. And I cover that in other episodes. Now, let's go back to your applying for this policy. Well, the insurance company, Underwriters, they have to check out your health. Those are medical underwriting guidelines, but they have to check out, do you qualify financially? Sometimes people say, well, if I want to apply for $1 bazillion of life insurance, why can't I? Unfortunately, because there are crazies in the world that they tell their followers, because they're a cult, go take out 50 million of life insurance, strap a bomb around you, and then we'll get 50 million to fund our cult. Yeah, there's terrorists out there that would take advantage of that like you can't believe. So you can't be earning this much money and qualify for $1 bazillion of life insurance. It doesn't make sense. You can't afford it. So they're going to go, where's the money coming from? Does that make sense? So you can only qualify for a certain amount of insurance based upon your income or your net worth. For younger people, let's say a 30-year-old, and let's say a 30-year-old's married and has 4 children, you can qualify for 30 times your income. If you were making $100,000 a year, that's $3 million. Okay, pretty much no question. If you're applying for up to $3 million of life insurance, the financial guidelines say we're okay with that because $3 million is reasonable to make sure that if you died, that your beneficiary, your spouse, and your children would need $3 million at conservative rates of return to continue to generate $100,000 a year and keep ahead of inflation to make sure your children have education, piano lessons, and so forth, okay? So, see, life insurance is designed to pay out an immediate estate of the economic lifetime value if you would have stayed around and lived. Does that make sense? Well, that was a 30-year-old. 30 years later, you're 60 years old. Now the insurance company financially is only going to approve you for maybe 12 times your income. Well, how come? Well, because you're 30 years older. You don't have any children left at home. They should be independent by then, okay? Even though some move back in with you, I know that. But now your spouse, if you died at age 60, there's 30 years less that has to be provided for because you're 30 years older. If your life expectancy goes to age 90 at age 60, the death benefit only has to generate money for 30 years, not 60 years, because you're older. Does that make sense? So they'll only approve you for maybe 12 times your income. Now, if you are trying to apply for more insurance than that, which many of our clients do, because what they're doing is they're repositioning assets. I've had many clients inherit hundreds of thousands, millions of dollars, or some people are real estate rich, land rich, cash poor, like farmers. So they don't have much of an income, but the IRS says their net worth is $5 million. And they're trying to apply for insurance, but they don't justify being qualified for, $5 million of insurance because they don't have enough income. And you say, well, how are they going to afford it? Well, maybe they're repositioning assets. Maybe they're going to sell 50 acres. Maybe they're inheriting some money from their father, who was the original, rancher or farmer, whatever it is. So now the insurance company will approve you based upon a factor times your net worth, not just your income. Maybe a combination of both. So pretty much older people that are worth a lot of money, they'll qualify you for 100% of your net worth, no questions. If you have a net worth of $5 million, they'll qualify you for $5 million. Does that make sense? Well, there's a lot of times we have clients that we need to qualify them for 2 times their net worth because we're using leverage. Or it may be a huge factor times their income because they're about to increase their income dramatically, or they'll inherit some money or some impending event. So we have to get exceptions with the underwriters because we are going to end up with far more income or far more net worth than it looks like right now. So the underwriter needs to know, why should we justify this much insurance? What are they betting on? Okay. And if it looks very predictable, then they'll approve it. But those are called financial underwriting guidelines. That's why it's important to understand this. If you work with a proper IUL agent and they don't understand how to write a cover letter and explain the reason and justification, you could have qualified for an IUL policy that accommodates this, and they'll only get you approved for this because they didn't know how to do this. Because if you're repositioning assets to increase liquidity, safety, rate of return, and tax benefits, and those assets need to be liquidated, or you're going to receive them in an inheritance, or they're coming out of, they're not in hand today. Maybe you're going to get a huge settlement, or you're going to sell your business for millions, but that business is only cranking out 100,000 a year right now, but you're selling it for 15 times your income. Well, you need to tell the underwriter, I'm selling my business for 15 million, even though it only generates $1 million a year. Well, that's why you need to understand how to get you approved with an expert. Okay? So that's what financial underwriting guidelines are. You can't just apply for any old amount. You have to prove that there's going to be an economic loss suffered by virtue of you dying. But if you're self-insuring, if your money's going to grow to equal and exceed the death benefit within 10 years, if they really see that that's the pattern of your clients, they will usually approve your clients for far more death benefit than they normally would. Many of the companies and underwriters that use us, they don't even ask for cover letters a lot of the time because they see the pattern of people that apply for more than their income or net worth ratios, but they know they're going to fill it up with cash so fast that the actual net amount at risk is going to be zero within 10 years. So they don't worry about it. If they qualify medically because their life expectancy is beyond 10 years, they pretty much go, you know what, Doug, your clients become self-insured and our risk goes down to zero within 10 to 15 years. It gets less every year that they fund their policy. So now, because of that, I can get them approved for double and triple what most agents can. Well, a properly trained IUL professional can do that. So the message here is this. If you want to learn more about this, I would strongly recommend, first of all, you study my book, The Laser Fund, because we talk about it in here. And laser means liquid assets safely earning returns. A laser fund is a properly structured, max-funded, indexed universal life. And many of these are way bigger policies than normally would be approved based on medical or financial underwriting guidelines. So you'll learn how we get it approved. But this is a 300-page book. It retails for $20 on Amazon. And if you buy one on Amazon, thank you. But I'll gift you one for free. This is not about me. This is about you. I want to empower you. And so I require a little bit of skin in the game. You simply click on the link below, laserfund.com. You contribute a nominal amount towards the shipping and handling. I'll cover the rest of that cost and I'll pay for the book. And I'll fire out a hard copy to you via priority mail. Now, while you're in there claiming your free copy, if you'd like to listen and learn and watch and learn, there's audio and video formats available for your investment. But there's an option there where if you want to talk to a certified IUL professional, there's just a handful in America. And they all have to go through a very strict certification process. It's a lot of training, but they have to pass a 100-question exam with 100%. 70% doesn't cut it. 80%, no. They have to pass it with 100% before they become certified. Wouldn't you want somebody operating on your brain that has a 99 or 100% success rate rather than going to a brain surgeon or a heart surgeon that goes, well, 70% of my patients make it through, but this guy 100% does. Which one do you want to go through? The one that 100% come through, right? And so when you're in there claiming your free copy, you can schedule a quick consult with no cost, no obligation with a certified IUL professional. And you can see how these can work in your particular set of circumstances. And there's no obligation that you have to use that certified professional. But frankly, I would, if I were you, to make sure it's done right. Don't just go to a nephew or an uncle because they have an insurance license, because I can assure you they probably won't understand how to structure it correctly. And so they'll help you implement it. They get compensated with no fee. They get compensated by the institution that has to help you through a licensed individual. If they can be that licensed individual, they get compensated and they can waive fees. So I think that's extremely fair if you choose to implement it. But that's what I want you to do. This is for you to be able to make sure you understand how to do it right and that you can get through underwriting medically and financially with somebody who knows what they're doing so that you can get approved where a lot of agents don't know how to do what I'm talking about.